Welcome back to another video. In this video we're going to look at a buy, borrow, die real example portfolio. Now what's special about this is it's the exact algorithm of Interactive Broker. So we can actually see straight into the source code. Now looking at this, it looks like a 1940s computer screen. And honestly, this is really what legacy financial systems look like. And it looks terrible, but it doesn't really matter. What matters is the algorithm behind it. And I'm really just going to show you just how easy it really is to take out a margin loan for lifestyle on a buy, borrow, die portfolio. So on this portfolio, I've constructed a 70-30 barbell split. We've got defensive stocks, we have T-bills, and of course we have the NASDAQ. So I'm going to run through it. I hope you can see this. So I've constructed this. This is, as I say, this is IBKR's risk terminal. So it's the official algorithm of IBKR. That's why this is so special. So let's look at it. So what I've done, we've got a net liquid value of 10 million. So $10 million, and it's split across all the stocks that we can see here. So NASDAQ, Waste Management, O'Reilly, Walmart, Visa, and Treasury bills. Very straightforward, very simple, basic barbell portfolio. Now what you can see here is this is on a Reg T margin account. So you see here, maintenance margin at the top, 2.5 million. So that's just 25% with an initial margin of 5 million, 50%. Now, when I talk about buy, borrow, die, we're never going to borrow more than 50% anyway. So technically, you can use a Reg T margin account if you want. You don't necessarily need a portfolio margin. Portfolio margin will give you a lot more room for leverage and buying power. But let's look. What's the most important thing to see on the screen is the ES and the VAR. This is IBKR calculating. This is a broker calculating on a 99% chance what is the most it would get lost in a day. So they're expecting the portfolio in a bloodbath crash only 4.5%. As you can see there. So that's really not much at all. But see, retail traders have been programmed to believe that obviously the stock market's like a casino that can just crash tomorrow. And it's really just not like that. This is the inside view of the algorithm and how it actually calculates the risk of your portfolio based upon the stocks that you have, and most importantly, if you've got an ETF. And in this portfolio, look at this, we have an unrealized gain of 5.4 million. Yeah, unrealized profit and loss. So we have a choice then. Our choice is, do we want to sell the stock to fund lifestyle? You know, we want to sell that and we want to go buy something. We want to buy a watch, a car, you know, go on vacation, clothes. But of course, we know we will pay, you know, long-term capital gains tax. Because this is a taxable broker. This is not a 401k. This is not a Roth IRA. We're not interested in those in the buy, borrow, die framework, because you cannot borrow against a 401k at institutional margin rates or a Roth IRA. You just have to wait until you retire and you get taxed at income level tax brackets. Taxable brokerage is called a taxable brokerage, but yet it turns out to be one of the most efficient tax shelters available. So let's imagine we said, okay, we're not going to sell the stock. We are going to take a margin loan. Yeah, this is really how easy it is. Okay, so we would go on to the brokerage. We would click withdraw $2 million, and we press a button. The money goes into the bank, and you have $2 million. Yeah, so we've borrowed 20%. Now watch what's happened here. Watch what happened. We have got a net liquid value now of $8 million. However, the portfolio is still worth the $10 million. Yeah, so borrow the 2, it's still technically worth the 10. And those stocks, the NASDAQ, they will continue to compound now forever. We do not interrupt it. We could have sold $2 million worth of stock, but that stock will never compound again. It's been severed. But we've not done that. We've allowed the full balance, the full portfolio to just continue to grow and grow and grow. We don't pay tax on that $2 million because it's a loan, it's not income. And what you'll find is unbelievable, right? How much you're going to say, how much interest is that going to cost me? It is, on current margin rates, it's about $87,000 a year. But if you look our P&L for the day on this portfolio, I hope you can see that, 94,000. That's just on the total. That is just the portfolio on average. The NASDAQ today, because this is live, $104,000. A year's worth of interest is being paid technically in 1 day of trading. This is the power of the financial markets. This is where labor is detached from your body and it's in the hands of the financial markets. $104,000 just in a single day. You know, that's just the NASDAQ portion. And what I've done with this portfolio is I've given it 5% is in T-bills, and then roughly a percentage, about 600k across 4 defensive stocks. And I want to make something really clear about defensive stocks. They protect the NASDAQ and the NASDAQ protects them. Because in a full-blown crash, like an absolute apocalyptic COVID crash, all stocks will crash. I don't care if it's Walmart, Waste Management, Berkshire Hathaway. Technically, on an absolute doomsday, everyone just sells everything. And the broker will hike the maintenance margin on single stocks. Yeah, right now our maintenance margin 2.5, but that could go up. But the good thing is the NASDAQ, because it's an ETF and the broker appreciates that they can't hike the maintenance margin on the NASDAQ or the S&P 500 because that would cause a total death spiral. They kept that at 25%. They did that during COVID. They've done that as long as most investors can know. The only one time they did increase it to 33% was before the election. I think it was back in 2020, I believe. I can't remember exactly, but it was when the election results were coming out. And they announced this in advance. But again, we weren't even anywhere near a margin call. So that's what's good. If in a doomsday situation, the ETF protects because its maintenance margin doesn't go up. It usually stays at 25%. Okay, so that's something important to know. But look what we've done there. We've just taken $2 million out of our portfolio. The portfolio just continues to grow. The unrealized P&L goes up. And next year, imagine the portfolio goes up, 15% next year. Because we've got a lot of growth, aggressive growth. The debt shrinks. That is the buy, borrow, die strategy. We don't sell the assets. So the net liquid value goes down, but our gross value stays the exact same. Yeah, so I always talk about the NASDAQ, as you know, because it is a strong growth performer. We need the growth to make the strategy work because look, we're paying $87,000 a year on the loan. So we need the growth to shrink that fast enough. It's a race between the assets and the loan debt. So if you're just too much defence, you're not going to be able to outperform if you're borrowing. So we need that growth. And we want the growth anyway, because the NASDAQ has, for example, the NASDAQ has outperformed over the last 30 years. I was looking at some real estate numbers, and since 1996, look at what happened with Manhattan's prices have went up 500%. Properties in London up over 1,000% to 2,000%. Monaco was up over 1,000%. You see, not all properties go up equally, but the assets that really matter do go up with inflation, with monetary inflation. And that's why the NASDAQ has went up, 6,400% since 1996. This one here was 1995 on this one here. But you see that growth? The people that can buy the prime real estate, the prime assets, are the ones that had their money in the technology stocks, the growth stocks. Because we would get the money first when it goes flooded into the economy. That's why it's so important to measure against the money supply. That's why I keep talking about this. We don't measure against consumer price index. We don't want to be rich in eggs, milk and bread. What use is that? You deserve to be able to buy prime real estate. Maybe not in Monaco. Maybe that's not what you want, but real estate that's more expensive in your areas. If your assets do not go up fast enough, you will never be able to buy the assets you truly want. And this is why I do not believe the strategy works with the S&P 500. So it doesn't give us enough growth, especially if there's taxes involved, like on a 401k. It destroys and defeats the purpose. But there you go. This is the inside view. That's us looking straight into the source code. It doesn't look very glamorous. I can promise you that. It does look like terrible interface to what we're used to. But it is on purpose. I believe it's on purpose because it filters out retail. It filters out retail. It works as a filter. But look how simple that really was. There was no bank involved there. The banks are just financial transit. We transfer the money to the bank to spend it. That is it. Elite wealthy operators and family offices use a prime brokerage. Everything's in a prime brokerage. We don't have cash. We have T-bills. We have stocks. And we use that 2 million to buy. Maybe we want to buy other assets with that money, and we keep it growing. We keep our assets compounding. This is the buy, borrow, die framework. This is how we do it. And when you see the numbers, this makes it more realistic. When you see the P&L moving 100 grand in a single day, you start to question. The whole question of how do we pay off the loan starts to sound silly, because you just see the portfolio moving at 100k a day. I use such a big portfolio because the scale reveals the truth. You say, okay, I get it now. And now you say, well, a margin call doesn't feel that scary because look how far away we would be, from our maintenance margin. It would have to get absolutely obliterated. And at that point, it's just a fairy tale. We're talking fairy tales, not actual reality of what has happened in the past. I mean, the NASDAQ, surprisingly, I think it only dropped about 30% during COVID, which is quite impressive for a more volatile ETF. But when you can choose whatever stocks and ETFs you want, obviously, but you just want to have growth, especially if you're in your ETF. Your ETF decision is probably the most important decision to make, because once you have it, you're not going to sell it. That's the whole point of the strategy. There is no really reason to sell an ETF. That should just be held indefinitely. That's why we care so much about capital location as much as the allocation. The location just matters as much. Someone could spend their entire life funding a 401k and funding a Roth, and it all needs to get sold, or it's in the wrong location. It's in the wrong platform. It's in the wrong broker, and they don't know till 10 years later. It's the decisions. They thought they were doing the right thing, but they weren't. This is why the strategy is vital, because it decides the wealth in the next 10, 20, 30 years. That's why I really am passionate about it. But I hope you can see those numbers clearly, and I'll be doing more portfolios and reconstructing portfolios so you can see firsthand with the real algorithm behind the risk management.